we're going to go ahead and get started. Hope everybody's got a pen, something to write on, something to drink. Sit back, relax. Don't get too relaxed. Don't go to sleep. But today we're going to talk about how to go from zero to $10,000 a month. And I think there's probably most people, 10K a month puts you in a different category. You're able to do some things that you weren't able to do before. Of course, there's people, in this group and probably on this webinar tonight that already make that kind of money. And so, what we're going to talk about today is, regardless of how much capital you have, starting capital, and if you remember, the capital is just money. It's just another name for money. And so regardless of your starting capital and how much experience you have or education, you can start this journey in investing and build a stable income. And so what our goal is tonight is to try and give you a breakdown, key principles of successful investing, real capital growth strategies, common beginner mistakes, and how to avoid them. My goal is going to be to show you a practical roadmap, how to move from the very first steps to a steady income, and we'll try to get as fast as we can to $10,000 a month. And so $120,000 a year, that goes a long way. And so, the average mortgage is probably $2,000 or so a month, and you still got, $8,000 left over. Now, keep in mind, $10,000 a month, that's also before taxes. So you might as well cut out 20 or 30% of that and carve it out to pay taxes with, because once you hit that level, you're going to be spending some money on taxes. And so everything we're going to talk about is based on real cases and experience. And so not a lot of empty promises or unnecessary theory. Most importantly, this webinar is going to show you how to create startup capital for investment, even without your own money. And so many people think you need to have large sums of money or you own a business or whatever to get started, and that's not necessarily true. However, the old adage, it takes money to make money, is the same in the investment world. You got to have money to be able to invest in something, whether it's a business or stocks, bonds, Del Mar, whatever it is. You got to have money to invest. And so we're going to show you some proven strategies, to gain market or gain capital so you can put it in the market. And that way you're not having to dip into your savings or whatever. And so we'll break down ways that are available to everyone that will allow you to quickly move from basically the idea to an action and start investing. Even if you don't have $1,000 in your account today, my goal is going to be to give you the tools that you need to start taking action and move forward. And so before we actually start investing, it's important for us to set a clear and understandable goal. Investing without a clear goal is like traveling without a map. You can spend a lot of time and resources, but never arrive at the desired result. And so before investing money, you got to ask yourself, why am I doing it? And so, just like with budgeting that we've discussed at a previous time, it's important to set those goals, and I'm the type that I like to write them down. And so if I'm going to, save money or whatever, I like to say, I'm going to save this amount of money to go on vacation this year. I'm going to save this amount of money to buy this particular item, whatever it is. And then I calculate what I have to save, whether it's weekly or monthly, to get to that goal that is out there in the future. And so those goals can be weeks, months, years, and even decades into the future. And so, if you want to draw an example, it needs to be something that's definable. And so whether it's I want to create a passive income, but I want to create a passive income of X, say $3,000 a month, or I want to save up to buy an apartment house or buy a house within 5 years. I want to provide, a carefree retirement in 20 years. Whatever it is, it needs to be well defined. And the clearer you are about what you want to achieve, the easier it will be to choose the right investment instruments and strategies. It's also worth understanding that how much money you want to save or how much money you want to receive each month, an accurate financial target allows you to calculate how much you need to invest regularly and how much income you should expect from those investments. And so finally, I think, if you prioritize what is most important to you, whether it's capital growth or creating a stable cash flow, your main objective is to increase the total value of your assets, and that will get you to where you need to be. And so generally, what you need to do, though, is to calculate that regular payment. What is it that you need? Is it a regular income payment? Is it just growth of your capital? Most people, at least those that I'm familiar with, have said, what I need most is money coming in every single month in addition to what I have now. And so a clear goal makes the investment plan more informed and structured and greatly increases the likelihood of achieving that desired outcome. And so investing is not a one-time purchase of assets, but it's regular, it's consistent, and you do it like on autopilot. And so for your capital to really grow, it's important to be systematic and start by determining a fixed amount that you're going to save each month. And that amount you'll allocate to investments each and every month. And this could be, for example, 10, 20% or whatever you're comfortable with of your current income. And so, I've heard it said target 15%, but if you can get higher than that, then it pays off. And so regular investing disciplines you and creates the right financial mindset. You learn to invest first and foremost rather than spend first. And so it's thanks to the systematic approach that the effect of accumulation and compound interest begins to work. Even when there's small amounts invested, steadily turn into those small amounts steadily turn into serious capital after a few years. And so you really be surprised. And so, if you'll take that and make it a habit, another saying that I've always heard is pay yourself first. And so on a regular basis, I pull off the top of everything, and this is gross, from whatever I make with my business, investments, otherwise. The very first thing I do is pull 10%, and that money is set aside to go towards the future investments that I'm going to be doing. After that, I pull off what I calculate is going to be for my taxes. Then after that, then the rest is money that gets spent on expenses and whatever else. But the very first thing I do is pull 10% off the top of everything. And I've done that for many years. And that 10% is what I use for investing and setting aside money for certain things. And then there are other things that I pull money off of for saving, for, buying a new car or whatever it is. And so, but for investment purposes only, that 10% gets pulled off and put into a side account. And so when investing becomes a habit, you stop looking for, the perfect moment to start, and it saves time. It reduces the emotional pressure, and it helps you move forward toward your goal without the unnecessary worry. And so if you're going to build a systematic approach, that's the way you have to do it to automate the process. And you got to think of investing as a mandatory monthly payment to yourself. Treat it like the electric bill or whatever. You got that bill, but you also have the bill that you pay to yourself for yourself. And so I consider it just as important as my mortgage, as car payments, or whatever. I consider that, and really on some levels, I consider it more important. And so it's going to eventually get me to a point that I don't have to get out of bed every single day and chase every dollar and chase my business. I can either sell the business or liquidate the business or whatever. And eventually one day I'll focus on my investments and what I want to do with my time rather than chasing the almighty dollar. And so the sooner you turn investing into a regular thing that you do constantly, the sooner you're going to start seeing some results. And once you start seeing the results, then you get motivated to do more. And so building a financial foundation for your freedom and well-being is what you need to be targeted on for. And so investing, if looked at from another way, is kind of like a living system. And it will change your world if you approach it properly. With new technology and markets and business models and entire industries that emerge every year. Just within the last couple of years, I've been researching AI and where I need to invest to capitalize on AI. For the last 10 plus years, I've been researching and where to invest in the cryptocurrency market and which cryptocurrencies are more likely to do well. Just like when I bought Bitcoin when it was only like $235 a piece. And I'm kicking myself now for selling a lot of it when it got to like $20,000 because I didn't think it would really go much higher than that. And now look where we are. And so it's bouncing around $100,000 again. And there are people that are saying it may go to $1 million. And so, much like I viewed 100,000 as not being able to get there, I'm now starting to second guess whether it'll actually make it to $1 million. It may one day. Now I may be, dead and gone by then, but eventually it may make it. And so these new technologies, and so what kind of seems like cutting edge yesterday, a lot of it can come and go quickly. And so you got to learn to capitalize on that stuff. And so that's why one of the most important principles of a successful investor is constant learning and readiness to adapt. And so the constant learning is the research that I do, the books and podcasts that I listen to, things of that nature. But it's also the readiness, and the readiness comes in the form of capital that you've already saved and set aside, or you have cash flow coming in from other ones that you can attack something when you see it and you want to buy it. And so you got to go, you got to, it does take time. You got to learn constantly. You got to read some books. You got to take courses. You got to listen to interviews, listen to other successful investors, study company reports. The more information you pull from more directions will give you a clearer understanding. If you just listen to one guru or one investor, or you read a book or whatever, you're not going to get a clear understanding. If there's an area that you're interested in, like AI that I am currently, there's information everywhere, and it seems like everybody has their own personal view. And so you got to absorb as much of that as you can and try to figure out, what the common denominators are and work backwards from that. So an investor who's going to be committed to that will always be a step ahead of all the other investors. And so you not only protect your capital, but you also take advantage of market changes, and with a willingness to learn, openness to new things, and an ability to adapt quickly. Those are the qualities that over time will bring not only financial results, but also real freedom. And so, it's amazing as you go through things, when you've got a good basis of knowledge, you don't get as freaked out over, weird reports and whatever else that you may come across. And so continuing learning, it helps to transform investing from a set of random decisions into a strategic process that will help you work toward your long-term goal. And so discipline is the ability to act according to a plan. And so, that's despite all external circumstances. Markets are going to go up, they're going to go down. News may be positive, war may be breaking out, who knows? But a true investor sticks to the same strategy. They develop that strategy and they stick to it. They don't make decisions based on emotion or change course because of short term events. There's a whole lot of people that back when 2008, when the market really collapsed and Lehman Brothers went out of business and it seemed like the whole world was coming to an end, there's a whole lot of people who liquidated their entire portfolio. And if you go back and look, it took a while, but eventually all of those values came back to where they were. And so all of those people that sold their portfolios thinking they were losing everything, essentially they lost a whole lot more than anyone else who stayed in the market. And so there's the old adage, buy the dip. And so buy the dip basically means keep buying even as the market goes down, because the market eventually will recover. And so learning patience and helping, it helps to withstand the temporary fluctuations, and you have to sit back and wait. And so discipline helps not only let the mood kind of fade a bit, but those qualities make investing a powerful tool because you're not as reactionary. And so if you're steadily doing it, constantly putting money into investments, putting it in, putting it in, putting it in, and you don't really worry about the day to day. I personally know of a couple of investors, and I'll bet you they haven't even checked their portfolio in 6 months. And so they don't worry about it. They have money that's automatically deducted from one account into another, and it goes into these things. They continue to work or run their businesses, and they don't check it. They have it, going to specific investments, and that's the way they want it. And every once in a while they go and they check it, but the day to day they could care less. And so success comes to those who can do the right thing with their money over and over and over again, even when there's no results. And so in investing, it's not always the smartest or the fastest who wins. It's in the most patient and the persistent who wins. And so when your investments start to eventually start generating income, whether it's through dividends or interest or gains from asset growth, it's important not just to spend that money, but to manage it wisely. One of the most powerful tools for capital growth is reinvesting the profit. And so, as we talk about reinvesting, basically what you're doing is channeling your earnings back into more investments. And a lot of people would refer to that as compounding or whatever. But instead of taking the income out and spending it on consumption, and there will be a time for that. And essentially, for me, the time when I will begin to spend the income and the profits from all my investments will be the partial when I can take a partial amount of what I make off of my investments, and that partial amount exceeds what I currently make with my business and what my wife earns and whatever. When I finally get to the point that only a portion of what my investments are bringing in outweighs what I'm making with my business and my wife's income, at that point, I'll know that I can basically retire or walk away or start another business or whatever. I can spin things off. I can put my kids into business. I can do whatever, because I will no longer have to get up every day, run my business, oversee all my people, meet with clients, and do all the things that I have to do every day. And so I haven't reached that point yet, obviously, but I do have a plan, and so I'm hoping to get there within the next 5 to 7 years. And so reinvesting basically means that you're going to take the earnings and you're going to channel them back into more investments. And so you're growing the portfolio. And so instead of taking the money and spending it, you are using it to strengthen the foundation for even further growth. And so this allows you to take advantage of the compound interest effect And so when income starts to generate additional income and then more and more and so on. And so, there's nothing wrong with taking some of your profits and spending it if you need to spend it, or you just want to, or you want to treat yourself or whatever. But the issue is, once you reach, say, let's say you reach $100 a day, $3,000 a month. You don't need to start spending $3,000 a month. Okay, spend $200, $300, $500 a month in addition to your current income. You can pay down debts. You can, save for whatever you want to save for, but some of that money still needs to be rolling back into your other investments. And so it's through reinvestment that you can actually achieve results that, over several years, they really seem, unattainable, but over a while, it goes pretty quick. And so even small amounts invested back into your assets significantly accelerate capital growth, and take you towards those financial goals that you put on paper. And so psychologically, reinvesting develops a mindset of accumulating and increasing your wealth. And so you begin to see money not as a means for instant consumption, but as a tool for building a sustainable financial base. And so when your investment portfolio finally starts to make a profit that's pretty significant, don't take it as a signal to start spending money, but as a new stage. Make the investment your standards, and you'll see how in a few years capital will start working for you more and more efficiently and quickly. It begins to build up really fast. And so the growth curve is really, really fast once it reaches a certain point. And so remember, the more profit you leave working for yourself, the more freedom you will have tomorrow. And so the most important thing for an investor is to be able to see and make good use of the opportunities that life offers. Markets, technologies, business projects, changes in the economy. They're not just events, they're invitations to action that open the way to growth and success. And so, there's the old saying, luck favors the prepared person. And so it's not always luck, it's just the fact that they set themselves up to be in a position to take advantage of a situation that comes up, even if the situation is something that they don't even see. And so a successful investor, prepares for these things. And so they don't just sit back and wait for a perfect moment and then try to take advantage of it. They set themselves up, they analyze things, they make decisions. And so when something does come up, then they can seize the opportunity. And so, like many of you here in Del Mar, this opportunity showed up and you seized upon that moment. Some were capable of investing larger amounts, some not so much. Regardless, you were actually, whether you realize it or not, whether haphazardly or not, you were in a position to take advantage of this situation and begin to increase your investment portfolio through the investments with Del Mar. And so it's important that you realize those kinds of things. And so it didn't necessarily just happen in happenstance, as they say. Life always seems to give opportunities, especially to those who are ready to see and act on them. So, take advantage of them as they come, but you have to be prepared to take advantage of them. And so you got to be constantly learning. You got to keep the goals clear. You got to be working on your financial discipline and building your capital in the background, and being open to new things. And so, before all of us heard about Del Mar, it was all new to us. And so we all capitalized on that when it came about. And so history shows wealth is created not by those who tried to guess the future, but by those who saw the opportunities in the present and they acted upon it. And so remember, the opportunities don't necessarily wait. They come, they open, they leave, the doors close, and afterwards you look back on it and you think to yourself, man, I wish I would have done that. And so, I try my best not to be that person that looks back and thinks like that, because I don't want to look back and think I should have done something when I didn't do it. And so One of the things that we're going to talk about tonight is also leverage. And so, using loans or credit uh, to create a new asset is not necessarily a bad thing, as long as the return on the investment is high enough to service the loan, pay off the loan in a reasonable amount of time. And so, for an investor, credit can be a tool to accelerate your growth. Some people don't like it, but other people do. And so when you properly plan a leveraged investment, uh, it can help you launch major projects. It can help you grow your portfolio. Uh, you can enter into new markets. You can open up a new business, whatever it is. It allows you to act when the market is open to opportunities rather than waiting for ideal conditions and wasting time. One of the things that I have that some may want to consider is I have an open home equity loan. And so I have a tremendous amount of equity in my home. And so I do have a home equity account that is there open. And if I see something that I want to jump on, there's a significant amount of money there to be used for that purpose. Now I'm real careful about when and how I use it, but that is a way to go about it. Um, Especially if you've got a good interest rate on your mortgage. If you have a mortgage, you don't want to refinance the mortgage and take the money out and create a new 30-year mortgage with a much higher interest rate. So if you can go and get a home equity line of credit, and with a HELOC, they call it, you can access funds that way. I know people they use their HELOC, they use it to buy a car with, they use it to do all of these other things that they do, whether it's investing or whatever else. And the reason is that the interest and everything that goes with it, they're paying it down, but it's underwritten by the house that they're in, just like I am here. And so they're essentially borrowing money from themselves. You're still paying the bank and some interest and whatever. But in a lot of cases, it can be attractive for a lot of people to do that. And so other people have been known to borrow from their life insurance policies or whatever else. There are ways you can do that as well. And so there are a lot of different ways to access capital if you're willing to go and research it and look for it. And so this having that large amount of money will allow you to take advantage of different opportunities. And so you got to remember, though, credit has to be used consciously. Funds need to be allocated to workable investments that generate income that exceed the cost of the loan. It is this approach that allows you to turn borrowed resources into assets that create financial freedom. So knowing how to work with credit reduces resources is a skill of a more mature investor. It's not necessarily for the novice to go out and borrow a lot of money and try to create assets or buy stocks, bonds, whatever, then try to generate an income above and beyond what you're having to pay the bank. So, it does kind of push your limits but it does help you reach your goals faster. And so remember, the right kind of loan is essentially a gas pedal for your financial growth. And so in order for borrowed funds to really help with financial growth and not become a burden, it's important to adhere to some simple principles. Use credit only for asset creation, not usually for consumption. And so credit should work for you, not against you. Use the loan proceeds only to purchase or develop assets. Those will generate income or increase in value over time. And so before taking out a loan, you got to compare the return on the planned investments with the cost of the loan. The return of the investment should significantly exceed the interest rate on the loan. And so, for example, if the investment potentially yields, say, 15% per year, and your interest rate is 7%, that's reasonable and generally a workable option. If the difference is minimal or non-existent, it's really, you need to reconsider. I know back years ago when I did a lot of investing in the real estate world, and I was buying houses and remodeling and flipping, and I had some rentals and whatever else. I can remember I bought a specific property. I bought that property for about it was in rough shape for about $50,000, and then I remodeled it for about $30,000. But when I finished all of that, the appraised value on the property was about $160,000. I put a renter in that property, and then I went and sat down with my banker and determined a mortgage to pull on that property that left me with positive cash flow from the rental every single month. But I pulled my cash back out of the property that I had in the property, and I used that cash to go buy another property and started to rehab that property and did the same thing with that one. That one I actually did finish the rehab and sold it so that I got all of the return all at one time. And then I used that return and I bought two separate houses. And so I did that for a good many years. Some houses I did really well. You know, it's like you hit a home run, and other ones I didn't do so well. You almost break even or barely make any money. But regardless, in the long term, you're still making money. And so it's important to consider what the repayment terms are on a loan when you're planning for that kind of stuff. And so try to plan it in such a way that you can safely service the liabilities from your investment income or reserves. One way to consider this is, if you're going to approach, this kind of thing, would be to borrow an amount of money that you can make the payment if something goes sideways, or if you have money in savings or whatever. If worst came to worst, you could always take the money out of savings and pay that loan off. You would, still have to save your money back up again, but at least you wouldn't have that loan still hanging over your head. And so you got to have a safe strategy, an exit strategy, some people call it. And so you invest not only with borrowed funds, but also part of your own money to help maintain the financial stability and the freedom of doing that. And so work with transparent terms, choose loans, that have clear interest rates, don't have hidden fees, don't get balloon payments, don't get interest only with, something that changes 3 or 4 years later. The simpler the terms, the easier it's going to be for you to control the process and focus on capital growth. The formula for using credit wisely is pretty simple. Borrow against assets, make sure the return on the investment is higher than the cost of the loan, and always calculate payments so they don't put pressure on your personal budget. And so a loan is not a lifeline, really. It's a gas pedal, and it helps move you towards your financial goals. And in the hands of a competent investor, it becomes a powerful tool for growth. And so when we talk about using credit for investment, it's important to understand that the path has been followed by many great investors and entrepreneurs. You're not going to be the first one to do it. And so many of them created fortunes from nothing. They used borrowed money, and they didn't use it for consumption. They used it to build businesses, build assets, and the rest. And so they used it to generate a stable income in the long run. And so, one of the ones, is kind of in the news today. And why is this not working? There we go. And so you look at some of the names here that are listed. Donald Trump, early in his career, actively used credit to buy real estate in New York City. He borrowed funds to purchase properties and increase their value through renovation and repositioning, and then earn money by renting and selling them. His formula for growth has always included the judicious use of borrowed resources. However, those of you who know the history of Donald Trump know that he got himself way deep, and he's had to file bankruptcy on properties over the years because he went too deep. And so obviously he must have learned along the way to either recalculate or to be a little more conservative, because he has been able to amass several $billion in assets across the world. And so obviously in his early days, he was probably a little more cavalier than he is now. And so another one is Sam Zell. He's a famous real estate investor. And he started with buying income producing homes with borrowed money, and he built a portfolio, refinanced the assets, and expanded his investments by using other people's money. And so, the old OTM, other people's money, um, it can help finance deals. It can help, ramp up your investments, but you gotta be careful. And so even, Robert Kiyosaki, he used mortgages to buy real estate back in his early days. Obviously, he's probably got enough cash flow and income coming in from those properties now that he can buy them with his own funds. But and I actually saw something not too long ago that between him and his wife, they have over 6,000 properties. Just imagine that, what the cash flow coming in from that. And so, in his early days, obviously he used loans and whatever, kind of like I did, in doing it the way that I did with renovating properties. And so Grant Cardone, if you've ever heard of him, another well-known investor, another entrepreneur. He's now seems to be selling an awful lot of courses and things to teach people to do stuff. So I'm not sure how much he's actually, managing all of that real estate, or actively in the real estate world, other than his existing properties. But he does talk about how loans, have been the foundation of his growth strategy. He's used debt to buy large residential complexes and increase his assets and therefore profitability. Even somebody like Ray Kroc, the founder of McDonald's, claimed he built the business through active leverage. And so he mortgaged everything he had to open new restaurants, and he turned debt into an ever growing stream of income. And so I don't know if you guys have ever heard the story behind that. Somebody asked him what time, at one point, uh, they had an interview with Ray Kroc, and he said, "Well, what business do you think I'm in?" And the person interviewing him said, "Well, you're in the hamburger, business, what, a restaurant business." He said, "No, I'm not. I'm in the real estate business. McDonald's owns the corner of virtually every major intersection in every major city all across the United States, and now in multiple countries all across the world. Wherever there's a lot of traffic and a lot of people, McDonald's has usually got a property right there next to the intersection." And so the franchisee, in most cases, are the ones that put the money up to get the franchise, but the underlying ownership of the property and everything, McDonald's in a lot of cases owns those properties. And so imagine that one for a moment, what the value of that is. And so, what do all these people have in common? They saw borrowed money as an opportunity, not just a risk. And they used the credit as a tool to create assets that worked for them. It generated income and it increased more capital. They acted deliberately and they acted strategically. And today, everyone, all of us, we have the same opportunity. It's only important to assess your steps wisely, use resources wisely, and remember, credit can be a powerful gas pedal if your movement towards financial freedom is working, and if it works for you and it's not working against you. And so, one thing I want to do, we kind of, I guess, advertise this as 0 to 10,000, and so we're kind of gonna try to reach that now through this strategy. And so, what I want to share with you is a strategy that will allow you to reach a steady $10,000 a month income by leveraging your Delmar Energy investments with smart leveraging. And so, step one, and you see it right here. Okay. First is to prep and plan. And the task is to determine the amount you're willing to borrow if you're going to go this route, and draw up a clear repayment plan. And so we know from the returns that, the repayment path is somewhere in the neighborhood of about 90 days or whatever. And so it's important to think not only as a consumer, but as an investor. A loan is not taken out to spend, but it's done to create the asset. And that will work for you on a daily basis. You will need to calculate the monthly loan payment in such a way that it can be easily covered even by partial profits from the investment. And so step two is to choose an investment direction. So Delmar Energy has several directions available with daily payments and high yields. And so, for example, plans with daily rates from 0.952 all the way up to 2.1% per day for larger investments in shorter time frames. So when choosing a direction, take into account contribution term, the term length, the minimum entry amount, and the expected return on your investment right there. And so the task is to allocate the credit funds to areas so that the daily payments start to arrive at once and their volume gradually grows. So, we didn't calculate it and I didn't see it here, but let's just assume, let's call it a round figure, $100,000. And I don't have my calculator, should have thought about that. But let's just call it, let's say $100,000 if somebody were to do that. And so, if you're going to be at that, and let's even start at like the lowest amount, I think there's one like times 0.0135, if I remember correctly. And so you're talking about $1,350 a day coming in, times 30 days in a month. That's $40,000 a month. And so you divide that, or, into your investments, and you're paying off the loan in 90 days. But you still have after that the residual $40,000 a month coming in for another however many days, another month or two. And so that leaves you with a residual amount of capital that's pretty large, even after you've paid off the initial loan amount. And so the main goal is to cover the monthly loan payment as quickly as possible. And that gives you the confidence to takes the pressure off, kind of thing. It's important to be disciplined in allocating a portion of the profits to your loan payments and reinvesting the rest. And so, along with repaying the loan, you reinvest a portion of the profits back into new areas of Delmar. Through compound interest, your daily yield begins to increase. And really, it's not compound interest, it's compound investment, because you're putting money coming from one investment and you're rolling it in to create a new investment. And so that's kind of the compounding effect. And so by doing that, the daily yield begins to increase. And even if you only did this with $1,000, you're talking about $10 coming in, and you doing that instead of 100,000. And so you speed up the process. And so if you use the strategy correctly and manage the funds wisely, in 6 to 12 months, you will be able to reach a net profit of $10,000 a month, roughly. And so if you think about that, a lot of people thinking in terms of $10,000 a month. I don't know why all of a sudden my camera is doing its thing here. Try to set that back up. It's like it's getting tired or something. So if you use the strategy correctly, 6 to 12 months from now, you could create a $10,000 a month income. And so, this is not a one-time sum. It's a steady stream coming in constantly. And so you attract the loan and use it as startup capital, invested in the assets with daily repayments schedules, and systematically service the liabilities, reinvest the profits, and only with this, you'll achieve that financial independence. And approximately 6 to 12 months is what we're calculating. And so, most importantly, this is the way professional investors build assets, and they do it with borrowed funds rather than saving up for years and losing the best market opportunities. And so, when you reach a steady income of about $10,000 a month through smart use of credit and participation in Delmar Energy's investment plans, you're not just getting money, you're creating a whole new financial level and new opportunities for yourself. And so a steady income allows you to no longer depend on a single paycheck, employers, or the volatility of the foreign market. Your money works for you every day, and you manage your income yourself. A steady stream of money gives you the opportunity to accumulate capital faster for new large projects. And so at some point, you begin to be able to pull off of those investments to buy real estate, start a business, buy a house, buy a rental property, whatever it is. And so you start to sort of diversify those funds going into other areas. And so, and at the same time, you're still servicing the credit obligation, and then you pay that off as quickly as possible. And so not only that, but you also improve your credit score and your credit history. And so this gives you access to even larger loans at later points, on better terms, which means you can launch larger investment projects. And so people who know how to work with money, see opportunities, and maximize capital, they're always going to be valuable. And so your experience with investments makes you in demand in business circles and in partnerships and in business. So if you have the money and know how to access capital, people will actually seek you out in order for them to finance whatever it is that they're doing. I happen to know a guy that he's in the banking world, specifically in the mortgage industry, but back during the downturn with the housing market, he was in a really good position at the time, and he bought hundreds and hundreds and hundreds of properties. And over the last 10 plus years, after all of that kind of fizzled out, he's been selling those properties, but he was buying townhouses 10 at a time for $5,000 a piece from specific banks. And then he was turning around, put those with a mortgage, excuse me, a rental management company. They manage the properties for him. And over the years, he's been selling those off. And now he is getting into what we call hard money or private financing. And so people come to him, they want to borrow money, and he charges them a fee above and beyond what you would borrow from, say, a bank, because he doesn't have all the other fees and all the other stuff that goes with it. And he also lends to people with credit that might be a little bit on the questionable side, but he always takes an equity position in their real estate in addition to the financing cost. And so guys making a bloody fortune. So, with $10,000 of passive income every month, you can start diversifying your portfolio. Get into new sectors of the economy, invest in, other projects, participate in startups, develop your own little financial ecosystem. When money comes to you every day, especially from like a Delmar situation, the feeling and fear, and there's no scarcity of the future. All that stuff kind of goes away because you open up your account every single day and you saw that it goes up again. And so you can afford to build things and choose projects wisely, and you can decide to live somewhere new, go move into a different country if you want to, change your lifestyle, but you gotta build to a certain point first. And so when you use the strategy of taking out loans and investing in daily assets, you get a number of serious advantages that you won't get with conventional savings or conservative investments. And so instead of spending years to save up, startup capital just to be able to invest, you utilize resources that are already available through borrowed funds and get right into the working investment system quickly. And this allows you to start earning income now, not sometime later. And so every day the investment plan, begins to work. It brings real cash flow. Then time begins to work in your favor. And the thing is, the earlier you start, the faster your capital begins to build, and the faster the income grows. And so the Delmar Energy plans are set up, for daily payouts. And so these daily returns add up pretty quickly. And this gives you, constant access to new money. You can repay obligations, reinvest money, increase the turnover, and manage your financial flows without waiting for long periods of time. And so part of your profits can be directed back into reinvestments, obviously, but creating a positive financial snowball is what we're looking for. And so capital begins to grow on its own. It starts accelerating in the achievement of financial goals. I think some of you have seen some of the investors, especially like in the Telegram group, who have come in and have, shown where they've invested for several years with Del Mar, and they have 100, 150, $200,000 invested, and so we're talking $1,500, $2,000 a day coming in. And so obviously they are using those funds to reinvest with Del Mar, but they're also using those to branch out into other areas. And so, by implementing this kind of a strategy, you develop the essential investor skills along the way. You learn how to manage your money. You learn how, to create a portfolio, and how to plan for cash flow, projections. And you learn the financial discipline. It becomes fun. I mean, it's like a game. And so these skills will stay with you for life. But, if you work on this for 6 to 12 months, you reach a stable passive income. And this becomes the basis for scaling up businesses and buying real estate and doing whatever it is. In the investment money, it's not just lying around. And so you put it together, put it to work, but the larger it gets, the faster it grows. And so stable income, frees you up from dependence on employment, allows you to choose your projects, it allows you to travel, build a business if you've always wanted to build one. And the strategy allows you to create an active cash flow, build equity faster, become financially independent, and manage your life using the tools that are available right now. So, the thing is, you got a choice to make. And so that choice, is basically, do you sit and do the same thing that you're doing? Or do you create a plan and learn to capitalize on it and take the opportunities that life has in store? And so, tonight we've kind of discussed this. It's Some people would consider it, something they may want to do, some they may not, but it is something that you do need to consider. And so, through the smart use of Del Mar Energy's leverage and investment plans, you're not just saving money, but you reach a steady income of $10,000 a month, and to build towards your financial freedom. And you can actually do this in 6 to 12 months, and not 3 to 5 years. I've been seeing people, note on the Telegram channels. And so what we're talking about here is, somewhere between Christmas and next summer, you could potentially be at that $10,000 a month if you sit down, figure it out, and you calculate where the investments go, which ones that you do, and how fast you do them. And so the greatest results are going to be achieved by those that who know the most, and those who start acting the fastest. And so each of you now have a choice. You can leave everything as it is, and in a year's time, you might have a little bit more. You might, go from $10 a day to $20 a day or whatever. Or you can use the tools that are available to you, start building those assets, and reach a new level of life and change your financial future forever. And so, this is the way I'm approaching this, and a lot of other people are approaching it the same way. And so, that's why we've covered this tonight. On this kind of a thing, time is your main ally or your main enemy, and only you can decide which side it's going to be on. I invite you to become part of the team of people who are not afraid to move forward, who seize the opportunity, who build their lives consciously and confidently. And if you start acting now, in a year, you're going to thank yourself for making that decision. And so we've kind of reached the end of everything tonight. Again, I really appreciate everybody being here this evening. I think we had a pretty large group of folks. I'm going to check it here real quick just to see. And that way we can kind of get an idea. We got a couple hundred people close to it in tonight. So I really hope you guys have enjoyed all the information tonight. And again, after I go and kiss the kids goodnight and tuck them into their beds,